Hey everybody, how are you doing? Welcome to Weekly Sense. It is December the 19th, 2022. I wanted to shoot a weekly sense before we finished up this year. Even though Carl's on vacation, there's a few important things that I kind of wanted to address going into the end of the year, looking into 2023, and go over those with everybody before the end of the year kicks off. So before I get too far into it, I just want to wish everybody a happy holidays. Whatever you're celebrating, I hope you have a safe and happy time with family members and a prosperous 2023. A few items on the agenda today. So obviously the Fed raised rates last week and they raised it to 425 to 450. Something important to point out from the most recent Fed announcement is that they plan to keep rates higher for longer. That was a clear message. They intend to raise interest rates to somewhere close to 5% over the next few meetings, the next one being in February. And they're projecting to hold those rates for most of 2023. And that brings me to a really important point when we're valuing risky assets or stocks. The risk-free rate of return, as many of you have heard me talk about, is a vital factor in that equation on judging what the future value of those companies' earnings are. And if you can just picture this entire year, we've been, slowly ratcheting up interest rates up to a point of where it's at right now. But the Fed intends to hold interest rates higher for longer. So let's use the real estate market as an example. So for many of you who I've talked to over the last couple of months, we've talked about the real estate market. So real estate really peaked in June or July of this year. Depending on where you're at in the country, it's down anywhere between 13% all the way up to 20%. So let's just call it right in the middle, somewhere around 15 or 16% on average. And that's only with absorbing incremental increases in interest rates. Imagine these higher rates there for a full year, right? They've really only been absorbing them since June or July when we started to actually see significantly high interest rates in the country. Now imagine for an entire year. And what people don't really understand when it comes to real estate is they think that the stock market is big. Well, the bond market is 2 times the size of the stock market. The real estate market is about 3 times the size of all of those other markets. So how goes real estate is a big impact on not only the global economy, but the US economy. And having to absorb these higher rates moving forward can put a big strain on a portion of the economy that makes up about 20% of GDP. So we're keeping that in mind. Now, in addition to that, we've seen inflation come down. It peaked at around 9%. It's right now somewhere right around 7.1% as of the last month's reading. And everybody's championed this. So you've seen the market do a classic bear market rally off of those October lows, just like what we saw off of the June lows. And that's all we really think it is a bear market rally. There's nothing significantly changing or improving with the economy other than headline inflation coming down from 9 to 7. Oh, by the way, it was at roughly 7 or 7.5% in February. So despite everything that the Fed has done, inflation has remained relatively the same over the last 6 to 9 months, despite all of the hiking that has gone on. But something important to point out is this notion of different types of inflation. At our firm, we have a theory that into next year, inflation will come down, but at some point it's most likely to plateau because of this notion of sticky versus non-sticky inflation. So sticky inflation are things like children's clothing, auto repair costs, motor insurance, medical care goods, public transportations, rents, also food away from home, alcoholic drinks, recreation. Those are sticky portions of inflation. They take a little bit longer for those things to work through the economy for them to come down. And you can see the non-sticky parts of inflation have been dropping drastically if you look at the top right hand of this chart. But at the same time that the non-sticky part of inflation has been coming down, these sticky inflation inputs have been increasing, which gives us a reason to believe that, over the next 6 months, that as the top line inflation number comes down, at some point we may plateau, which forces the Fed to keep rates higher for longer because they have a target of 2% on inflation. So outside of inflation, that's coming down. Retail sales came in just a week ago and they were weaker than expected. So, the chances of the Santa Claus rally are getting slimmer and slimmer. And the fact that retail earnings are coming up in the fourth quarter, coming up in just the next month or so, could put a pinch on a lot of those retailers if these retail sales are weaker than expected. So just something to point out as we get into earnings season over the next month or so. Next is earnings, right? As we go into next year, we're looking at corporate earnings. And, I don't think the market has fully absorbed the impact on earnings as we get into 2023. So the S&P 500 is down roughly 21% for the year. The NASDAQ down roughly 32. The bond market's down roughly, 13 or 14%, depending on where you're looking at. And all of that has been primarily due to this reset of interest rates. Corporate earnings, for the most part, have held up quite well this year. But when it comes to earnings, next year is where we could actually start to see some pain points as corporate earnings start to slowly roll over, as we think we're going to be closer to a recession over the next 3 months to a year. What's the impact on earnings? And I just don't think that the stock market has priced that in yet with regards to corporate earnings. So everybody's championing this Fed pivot. So Fed pivot meaning that they're done hiking rates and they're starting to cut. So I wanted to share a chart today with regards to Fed pivots, because coincidentally, when the Fed typically pivots, they say, oh crap, we need to cut interest rates. We've done too much. The economy is rolling over. That isn't necessarily a bullish sign for the stock market. So if you look at this chart here, this is historical Fed pivots that go back to the 1970s, and they typically coincide with market declines. So yes, we've seen a market decline, and I've been telling clients this for a while. I think this period could really resemble from a stock market performance period is the early 1970s, when Arthur Burns was the Fed chairman. And if Jerome Powell decides to cut interest rates because of the economy getting weaker, that may mean that it could be too late. So just because the Fed or the market is hoping for a Fed pivot doesn't necessarily mean that it's a good sign for the market, as done through history that you can see here. And lastly, I just wanted to wrap up. Everybody's kind of seen these charts. I wanted to update them. It's our Econ PI chart. So it kind of looks at the stages of a business cycle. And there's 4 main phases of a business cycle. You basically expand the economy. At some point, it starts to decline. Then it contracts into a recession, and then you recover out of that recession. So 4 main phases of a business cycle. And the reason why I wanted to update everybody on this is because the news from the economy is getting a little bit weaker. So we want to be a little bit mindful where we're taking risk, if we're going to be taking any kind of risk inside of portfolios. So again, the 4 main quadrants of the business cycle: expansion, decline, contraction, and recovery. Here are all of these different data points, from unemployment to retail sales to building permits to job openings, existing home sales. On existing home sales, there's about 1.5 to 1.6 million realtors in the United States. Bloomberg just published an article that about 800,000 of those 1.5 million realtors have not closed a single deal this year. And all of those realtors employ people, right? They spend money on advertising, and they stimulate the economy through their commissions of sales of real estate. So going into 2023, if these rates are going to be held higher for longer, it probably is a little bit of a problem for real estate going into 2023. But you've got all of these different data points, and this little red dot is the mean or the average of where all of these different economic data points are. And the closer you are to zero with that little red dot, the more recessionary conditions that are present. Now, another way to look at this chart is numerically. And this is typically how we go through it during our updates with our clients. So you've got, again, all of these different blue dots, right? So you've got retail sales, existing home sales, industrial production, non-farm payrolls, unemployment claims, all of those kinds of things. And the mean, or that red dot that we saw in the previous chart, is at 6.5. It was at 9 the month before, 11 before that, and roughly 13.5 before that. So it's at 6.5 today. And if we look at the 3 previous recessions, 90-91, 2001, 2007 to 2009, I'm going to zoom in here. About 6 months before those previous recessions, that little red dot that's currently 6.5 is currently 13.9. And 3 months prior to the recessions occurring, it's roughly 8.3. And 1 month prior to those 3 recessions occurring in the past, it was roughly 2.1. And we're currently at 6.5. So, we want to be, completely risk off. And that's how we've really positioned the portfolios for the majority of our clients, not only going into the end of this year, but also for the last, almost 3 months. Where we've got virtually zero equity exposure in many cases because of the inherent risk that we've discussed today. So that's a little bit about Weekly Sense. I know everybody really missed Carl. I hope you have a great holiday season, and I look forward to seeing everybody in the new year, if not before that. So happy holidays.
All opinions expressed by Andrew Whalen, employees at Whalen Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Whalen Financial. Whalen Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Whalen Financial may maintain positions in the securities discussed in this podcast.